things off.
All right. Thank you so much, Daryl. I appreciate the intro and good evening to all of you guys. Thank you for joining us this afternoon. I appreciate you taking some time out of your evening to swing by and see what the Simpler Trading crew has going on tonight. So thanks for being here. Like I said, I just thank you for the intro and confirming everything we've got going on there. It does kind of feel like a little bit like I need to say the date and the time before I get this started, as that's kind of what I'm in the habit with the chat room. But of course, this is a little bit more casual affair. So I appreciate you guys being here. Captain Kirk, thank you so much. Like I said, it's good to see you guys. Morning, Sunny and Jack, Stevie B and Neo. Hopefully, I've got some stuff to bring to you this afternoon that you'll find helpful in your trading and helpful. I think the progression of a trader is always an interesting thing to follow because you start learning a certain set of rules, you learn more things and expand off of that, and you start to find more trades and a style that really fits your personality. So, I'm very fortunate to have been able to learn from my primary mentor, of course, being John, and I've learned so much from him. But I feel like with anything, try to learn and absorb as much as you can and put a little bit of your own twist on it, and somewhere inside there, I think you will find, your niche. So excellent. Thank you, Sebastian. I truly appreciate your support. I know, like I said, I think everything's working well. So I'm going to continue to kind of kick things off here. And if you guys have any questions, as we go through this, if we have some questions that pertain to the topics that we're discussing, I'll try to spend some time on those. But ultimately, I would like to try to get through the presentation that we have here this evening, and then I'll be happy to answer any other questions that you may have as we get into towards the end of it. Afternoon, Bob and Paul. It's good to see you guys. And as far as those other questions go, I don't know if I can be too much help on that, but let's go ahead and get things started. So, as we open up, the first thing that just wanted to welcome you to this evening's webinar, the Unbalanced Fly Strategy, a blueprint for tilting the odds in your favor. My name is Henry Gambell, and I was fortunate enough to meet John Carter circa 2008 doing some in-home service calls through Geek Squad. We spent some time getting to know each other, and through the course of conversation, made our way to my passion for Texas Hold'em and the struggles that I had been facing trying to grow my Scottrade account, primarily just through trading shares. I had shown up there one day, and you walk in kind of like, what is it exactly that you do here, with a certain degree of fascination. And as we furthered along into our conversations, we started to find some similar qualities, etc. And as I found out more of what he had done, I talked about how difficult it had been trying to grow a small trading account at the time. Of course, working for Best Buy, I had, it was right around $4,000 or $5,000 that I was working growing through shares. You get into that point, it's like, all right. And mind you, at this time, I had no idea about a lot of this stuff, and I'd been trying to do it through shares. And then, through this course of this conversation, it's John, well, have you ever heard of options? It's like, please do tell. And from there, my future began to take shape. And I distinctly remember that moment because, he's like, he goes into just some of the very brief things about, well, it can be hard to grow $5,000 because of the leverage required. But if you step into options, these are some of the pros and cons. Let me talk to you about them. I took a job with John shortly thereafter and began to learn the ins and outs of options trading, primarily focusing on directional calls and puts, which is where I think a lot of investors and traders start. It's what a lot of your brokerages will approve you from right off the bat, ironically, of course, being one of the more risky ways to trade, but pretty much everybody can buy calls and buy puts, and that's where, I decided to focus. In an effort to help me get started, John granted me access to the demo side of his TradeStation account. Great, I thought, a real platform that I can practice on every day as I get ready to open my own. The process of logging into TradeStation was a little different back then, but if you weren't paying close attention at 8 a.m., it was all too simple to log into the live side of the trading platform as opposed to the demo side. It was one of those things where if you just tabbed over, you would have to tab over and hit enter to go to the demo side. But if you just type in your username and password and hit enter, well, then you're defaulted by logging into the real trading account. I don't remember my exact logic at the time, but I'd been trading IAG pretty actively through that Scottrade account, and I was, as far as I was concerned, that was the stock to own. When you you first start seeing these things and you do your studying and everything else, and that's the one. So, in the process of logging in, or let's see, yeah. So, and then there's the logo for it, just kind of like I said, it's always a company that'll have a special place in my mind. I've tried coming through and actually accumulating the actual physical share certificates, but I've had a hard time finding a brokerage that'll actually do that for me. But at one point, I'm gonna have some just because this meant a lot to me. So anyway, I'd been trading extremely small, no more than 100 lots on any stock trade, just to get a feel for the platform, to learn how to execute, enter and exit trades. This rocked along for about 2 or 3 weeks, and then the new year rolled around. Okay, I thought to myself, this is the time to start trading this demo account much more aggressively and just see what you can do with it. Because you go through the execution, you say, okay, I know how to get in and out. And, trading 100 lots, you ultimately got nowhere over off of this type of a demo account. And I felt like, well, I'm not really getting anywhere. Let's get aggressive and see what you can do with this. Not realizing I had logged into the live side of John's TradeStation account, I proceeded to buy 61,800 shares of IAG at the market, somewhere around $16.10. The day rocked along, and as I was working on setting up some new home theater equipment in John's office to watch Harry Potter in place of CNBC, I made a comment on how the demo trade that I took in IAG that morning had been doing. Right about that time, John went to buy some calls in Google, and we all know how it feels to hear that mechanical voice of order rejected. After putting 1 and 2 together, he realized what had happened and that my demo trade had actually taken up somewhere near about $1 million in real buying power. While I worked to regain my composure, I was quite relieved to see that the stock was actually doing pretty well, and I had to dig around and find this, but I did ultimately come back to this screenshot. So it was January 8th of 2010, and you can see here in TradeStation, when you place a limit order for these shares like this, it notes it on the chart as such, and you can see how that day progressed. This was the point where I had absolutely no idea what was going on. This was the point where I was setting up the home theater system. And then, of course, as we got into the end of the day, worked out of the position for the close, and once we were flat, had a profit near $34,000. So, a couple of emotions crossed your mind at that time, but mostly I was just thankful that, something had worked out in my favor that was such a drastic situation. And right about that time in my life, I'd also come across this book and this quote, and it says, well, that's the way it always is, said the old man. It's a principle of favorability. When you play cards the first time, you're almost sure to win. Beginner's luck. Why is that? Because there is a force that wants you to realize your personal legend, and it whets your appetite with a taste of success. So, somewhere in the irony of having this happen to me and reading this, going through this book about the same point in my life really got me invigorated. And, you just know, like, I feel like I'm right where I'm supposed to be. And such began my, my trading path. So now that you know a little bit about my path from how I got there to here, let's get into some discussion around unbalanced butterflies. Before diving headfirst into this strategy, it's worth noting a little bit of how I came to think about these the way I do now. I grew up trading very directionally, as I had learned this from John, and that can have some wonderful upside, but at the same time, that can have some pretty sharp downside too. You go from trading shares and getting a feel for the way that trades, and then you start jumping into options. And I also feel like for whatever reason, it's like, you you go through your trading career comfortable trading 100 shares of stock, but then when you get into options, you don't want to trade one option. You want 5 or 10 of them. And of course, I learned some tough lessons that way as I embarked on my trading career. A long call risk profile is pretty straightforward. And while I don't want to spend too much time on this, it's just the very basic layout of saying that when you look at something like this, you've got basically one way that you can make money with a long call or a long put. They can be great, when they do go in your favor, but you have to be right on direction and you have to be right on your timing. These are the main 2 points to consider when trading directional options. But as we all know, that's a lot easier said than done. Looking for something that was a bit more forgiving, I began to branch off into butterflies. And truth be told, this progression took several years because you move from directionals into verticals, from verticals into butterflies, from butterflies into iron condors and iron flies. And as we get into the actual meat of this course a week from today, I'll have more discussion on these because, as you build these different strategies and trade each one of them a lot, you start to get a feel for the pros and cons of each. And that's how I've progressed into where, what I'm going to be sharing with you tonight. Most traders are pretty familiar with standard butterflies. They trade for a debit and allow for you to profit as long as an underlying stays inside a given range. A risk profile graph for a standard butterfly is going to look a little bit something like this. And I'm not sure if my mouse is showing up through the screen share software, but the point that you want to look at with something like this is just noting that on each side, excellent, thank you, sir. It's not showing on my end, but I appreciate knowing that. It'll definitely help with the concepts I'm trying to share with you here. But with your standard butterfly, and if you haven't used the risk profile graph before, I would encourage you to really become familiar with it because there's so much that you can learn about this. And I've also found that there's usually two groups of traders. There's going to be either kind of the Excel and math minded trader, or there's going to be the more visual, and that's just kind of the two ways that you can learn things, generally speaking. So, in that way of thinking, I'm going to cover both. But this is the visual aspect of it that lets you know, okay, the peak of my profit, and I've just thrown one up here through SPX, but the peak of the profit in this strategy, requires that we basically stay range bound against the price that I have chosen. And if you exceed one of these measures, this is the biggest difference that you'll start to learn about these flies and some others. But when you look at these, if we were to exceed our price to the downside, that will result in a loss. If we exceed the given price to the upside, that also results in a loss. So, you start off and maybe you do these especially wide or whatever it may be, but there's still that risk that if some type of unknown event happens and it has a big jump in one way or the other, that you could wake up and be sitting, at a pretty significant loss. Standard butterflies can be an excellent strategy, like I said, but, can be a little bit tough in a volatile market. If you take a moment to think, why am I even considering a butterfly? You'll usually come back with a few common answers. I'd like to use a spread strategy that has defined risk. I'd like to place a trade that doesn't have to move perfectly in my direction to make money. Third, I'd like to have some type of a spread strategy on that offers at least, if not better, than a 1-to-1 risk reward ratio. And these are some of the characteristics of your standard butterfly that are beneficial. But if you dig a little bit deeper, some better criteria might include I would like to focus on selling as much extrinsic premium as possible. I'd like to have a better than 1-to-1 risk reward potential in every scenario. I'd like to use a spread strategy that gives me risk in only one direction. So if the market should have a rapid decline or a hard bounce, my management decisions become much easier to make. So as you compare the risk profile graph of the unbalanced fly versus the standard fly, this is the most important aspect of this to notice that if you are looking at this, and say, for example, we have a very similar way of thinking here, where we think the SPX could trade sideways, but we also think there's a significant chance that it could bounce here. Now, these aren't trades I have on. We'll discuss some that I have been trading. Maybe we'll get into some that I have on now. But this is mainly just showing you the difference that you can see two major things. The first of which is that this right side, as we've constructed it to be bullish, gives you no upside risk. always make a mental note of where your zero line is. And you can see that here on the left-hand side of the graph. That zero level is where we are at, essentially $0, making no money. So that would put our break-even point in this particular instance closer down to 2610. While if the underlying were to move higher, there is no risk to the upside. So it's a sharp difference from the standard fly where there's risk in both directions and you really have to stay dead set in the middle versus saying, if this thing hovers right in the middle of our positions, then that's exactly where we'd like to be. We still stand to benefit from the huge premium. And, if you can get something to pin, this still or stay inside a range, this still has the benefit of that. If it instead explodes higher, you still make money. And then, of course, the catch, as always, is to acknowledge your risk to the downside. So these are some of the basic ways that I have thought to myself that you take the standard fly, you adjust it just a touch to give you a more favorable risk profile graph. And now we can start diving into a couple examples. So with some of these that I'd like to start off with, and I'm going to use some live charts with you in Caterpillar, but these are my actual open to close orders for this. Now, and I also want to point out, I feel like the recent volatility that we've seen over the course of the past week it's interesting timing because there's really two times that I like to focus on this strategy. One is around earnings, and two is when you're having extreme market movement that can give you some good implied volatility. In this case, and for the next couple of weeks, I think we'll have both, right? Because we still have some good earnings reports that are due out, and at the same time, we have plenty of market volatility. And if you've never traded before, Travis, this may seem like a little bit to learn, but I would encourage you, I feel like there's so much that sometimes you can learn by just sitting and watching and just saying, okay, if I can pick up on a few things, I can still add this to my trading. If you've never done it before, yeah, there will be a little bit to learn, but if you at least have the basics of a call and a put, I think this can really, expand your horizons. Mind you, when I started doing this, I had no idea how these strategies worked, but it's my mission to work through this and explain it to you. And hopefully by the end of it, you'll have another good strategy to add to your arsenal. And on questions where you look at the unbalanced versus a broken wing, I am definitely going to get into these discussions with you. It's not really the focus of what I'd like to show you here. So I've got three very clear, distinct examples. I'd like to walk through those with you. And then if those spur some other questions, I'll be happy to speak to them. And no sweat at all. I just want you to understand that, everybody's got to start somewhere. And if you will at least expose yourself to this type of thing, you'd be surprised how much you might learn through osmosis. So as we walk through this trade idea, the one that I wanted to show you in Caterpillar was an excellent example. First off, because it's a little bit of a binary event, which is to say that you don't really have a whole lot of time that you have to sit here and manage it. For earnings, you've got the moment prior to the event and the moment after. So as you look at these trade executions, you can see that on the 24th of this month, we came in and we initiated 3 of the exact same unbalanced butterflies, utilizing the short 165 as the primary structure of this trade. As these next 2 days progress, you can see a couple of things inside of this. And this particular screenshot shows you my exact entries and exact exits. So you can see that we start off by scaling into it. You take that first trade at 53 cents. As we progress into the afternoon, the underlying begins to pull back a little bit. So you get a 55-cent credit, you get a 64-cent credit. And as with most credit spreads, the better the credit, the more advantageous the trade. Okay, all of these are entered on the 24th. Then we move into the next day. They release earnings, and immediately, right out of the gates, Caterpillar was trading pretty fair. In an effort to show how you can scale out of these and make your decisions as you go, right out of the gates, you can see 8:35:02, which is 5 minutes past the cash open here in Austin, Central Time. So right as we open, I say, okay, let's take the quick money and wrap this up and, at least have 1 out of 3 out of the way. You initiate it at a 53-cent credit. You sell the entire butterfly for a 75 credit, and that leaves you with a profit of about $130. The whole concept of initiating at a credit and selling at a credit is kind of a new concept, but it's something that I think you'll find to be extremely beneficial. Now, what do you see? We progress into the end of the day. And this is how I generally like to think, where for the first 90 minutes and the last 90 minutes, that's where I try to be most active and make most of my trading decisions. Okay, what happens as we head into a little bit later in the day? Well, Caterpillar falls. And what happens as it falls is it allows the intrinsic value of the 170 put to start kicking in. It's like the inverse of the Price is Right, where I want to get as close to 165 as I can without going under. So as the day progresses, and that's why you can learn so much just from these order execution, you see the one that was taken right at the beginning of the day, then you see the one that was much later in the afternoon. That closes out two of these positions. So if you take in the 55-cent credit to begin, sell it at a 170 credit, you're sitting at about $220 a profit for each single spread. Then we get into the final day, and this is sitting right here on Friday. You can also see, look at the time that this trade was executed. We'll go down into more specifics on this in the course, but to me it's always so important that if you're going to manage this as a single directional option, you've got to do it into the end of the day on Friday. So notice how I exit this long put option about 6 minutes before the cash markets close, and I close it at $3.05. Well, you know that if I'm selling the $170 put right at the close for $3, just based off that information, you know exactly where the underlying was trading at 167. That means that all you're left with is the intrinsic value of the 170. Everything that you sold down here, the big bulk of it, which helps you take in the credit at the 165 puts, all of those expire worthless. So you're selling your in the money puts to generate a credit on that, and then the rest of the transaction is left out there to expire worthless. And then, yes, Jim, these are opening for a credit. I know that it can be a little bit weird to look at this, but the reason why it shows up as it does is because you always want to buy a butterfly to open. You can see that all three of these bottom transactions, they are all to opened. So the odd way that they are noted is because you're buying a butterfly for a credit. And that does take a second to get your head around, but these are the basic concepts of it, and then we're really going to drill down into it as we start executing these on an individual basis. But this was a perfect example of scaling into your entry, scaling out of your exit as it goes in your favor, but also taking some off, when the profits are available. And then I thought the credit would be less to make a profit. Well, here again, let's not get too far off the path. I'm going to show you some very clear examples. And then hopefully by the end of this, you've got a little bit more of a foundation in it. The second of these that I'd like to discuss with you is a trade that we took in Amazon. So and all three of the examples that I'm looking at with you here today are based off of earnings, because I feel like if you can understand a trade based off of an earnings event, well, then it becomes very easy to understand from a swing perspective. Because if you put it on Thursday and you take the whole thing off on Friday because it's actually met completion, well, then you understand what would happen on a 30-day basis too, right? It just speeds up. That acceleration helps you learn the spread in one day effectively, and then if you want to apply them over a longer time frame, that's totally appropriate. So we get into the Amazon discussion. I like using earnings whispers to try to get a feel for, because for the longest time, you always looked at the consensus number, and then you say, well, if they met that number, but then still got hammered, it's a little confusing. Adding this whisper number into your analysis can be a helpful complement. So I'm going through the whisper number. I'm going through the earnings statistics, which it's so nice to have an in-house developer. We've got a couple of them, and having tools like this with your earning statistics is just extremely helpful. So I can look at information like this, and not to say that this is how I make all of my decisions, but it's very helpful to look at this and say, okay, over the course of the past 5 years, what types of moves have we seen up? What types of moves have we seen down? What quarters do those reflect off of? And it's really some pretty detailed information that I've come to appreciate more and more with this newest iteration of the indicator. So I always have these on the horizon. I know when earnings are approaching. I know which quarter we're set to report for. And I know how these quarters have done in the past, which helps me make intelligent decisions. Okay, so we go through a couple of these steps in Amazon and we decide to structure a trade very similar to what I had just shared with you. I'm looking at this for the potential of Amazon staying above 1360. In this particular case, I've done the butterfly $10 wide. And the main thing you want to think about is where you've positioned your body, because this is where we're thinking price does not go below. So looking at the chart here, I can see that Amazon was trading 1426, just a little bit prior to the report. I'm coming in and initiating the strategy at a 1360 put that is well out of the money, but some of these big pricey names can be some of the very best places to do this because you've got some good extrinsic premium in those far out of the money options. You'll find that as the volatility increases, and you'll find that around earnings, kind of saying the same thing, right? Except that you have to have market action to drive price, as where earnings will kind of create its own implied volatility. So these are two important places to consider this strategy. Okay, we're approaching earnings. I've got the bullish take on it, and then Amazon crushes their report. Think about the difference in this strategy versus where we were looking at the standard fly before versus the difference of the unbalanced. So you look at this and say Amazon reported 216 on a consensus that was 185 and the whisper number that was 189. So anytime you beat the whisper number by such a significant margin, you're generally going to see a pretty decent impact from that. So the next chart that you'll see is Amazon the next day. So right here in the middle, you can see where I've initiated that unbalanced fly, and we took in about a $3.50 credit on it. Notice here again too, we buy the butterfly, but you get the minus sign in front of it to let you know that that trade was taken for a credit. Now, as Amazon trades the next day, you can see you're up here around 1450. If we had had a standard fly around 1360, that never would have worked. But by initiating it for a credit transaction with no risk to the upside, we just pocket the credit received, and that becomes a very easy trade to manage. In this case, I love trading these from Thursday into Friday because that's when you're going to find the sharpest impact, not only from the crush and implied volatility, which you basically expect, but you're also going to see the crush in time because from Thursday into Friday, there's not really any time left. So you're really getting the best of both worlds on those reports, as opposed to trying to do it from something like Monday into Tuesday, though those can still work well also. So this was an instance where you put on the unbalanced fly and you're just, kind of thankful that it's there's nothing you have to do with it. So in this case, we just let that expire, you save the commissions on the way out, and you pocket the credit received. And then, so you check both the put and the call side before you put it on, or do you always use a put for a bullish and a call for a bearish? Generally speaking, Tim, you are going to want to use the puts for a bullish approach and the calls for a bearish approach because it's initiated as a credit. So that's kind of the big catch on that. And then how do you get no risk to one side? Well, it's really just the structure of the trade. So, we'll drill down into this and we're going to discuss the specifics of how you create these. I wanted to show you some examples, some real life examples that I've been trading in the recent market, to kind of get you a feel for if they fit your personality. So, these first two were relatively basic. The third one that I'd like to get into with you is a discussion on Apple. So let's go through this one, and then I'll be happy to take any other questions that you guys may be looking at. So as we come in and we start thinking about Apple, it's just the same set of criteria tried to run in a very similar way. So we look at a whisper number of 394, a consensus of 382, which I think that's important to note because the company can do so much to try to I wouldn't say manipulate numbers, but try to set the expectations. So maybe sometimes it's a little bit easier for them to beat their numbers because the consensus was set relatively low. The whisper number lets you know this is really what they should be producing to have any type of at least a significant positive result. They at least need to beat that number, and that's a good thing to keep in the back of your mind. So we take a look at this, and now we're going to come in and take a look at Apple the exact same way that we did in Amazon and look at our statistics around this. So I'm coming in and looking at this saying, okay, for this particular instance, this is where we are analyzing the Q4 results. I come back and I look at this and say the average Q4 6-day move was 1.2%. So if I know that over the course of the past 5 years, that on this particular quarter, the general results have been 1.2%, well, then I'm basically going to be looking at this for a relatively muted move. Okay. From there, I'm going to come back over into my options chain. And there's so much good information to learn from this chain. So as I'm looking at this and I'm trying to decide how I would like to position my spread, I'm thinking we're trading 167.70. The expected move is $7. How convenient. Now, it's not absolutely perfect, but it's pretty close to look at this and say $7 based off where we're trading right now. If that move resulted to the downside, then that should land us somewhere around $160. And 160 should act as some general synthetic support because that's where a lot of, the pricing of these options are setting it to where this is the defined range and the people selling against those ranges, have a vested interest in seeing them hold. So to the downside, we're thinking 160. To the upside, we're thinking 175. And that's about as clear as you can make it to say, $7.50 in each direction. That's where I'd like to structure the body of my butterfly to make sure that that's, to basically be working them around those expected ranges. If you've ever traded an iron condor and had a situation where that move came right to your range and really tested you, and you're sitting there sweating bullets over it, this will be a relief to start looking at it in a slightly different way because it uses similar concepts, but I think in a more effective way. So we start this idea by identifying our ranges. Then I'm going to come in and say, but remember, because we're still thinking that we're going to have a 1.2% move, kind of a tiny result. Okay, based off of that, I come in and begin constructing these unbalanced flies. Now, this is how you construct them, but notice in this case, and this is, we can go as far down the rabbit hole as you would like, and this is what I intend to do in the course, is really cover everything that I know about these and all the different ways that you can modify them to fit your means. Because as I was evaluating this, I really liked the ranges in Apple. I thought the ranges would hold. At the same time, the 160 put didn't give me just a whole lot of credit. So notice how as I come down this chain, I end up having to break a wing because had I done this as a balanced or a standard $5 wide on each side, look at how much more expensive that 165 put is versus the expense of the 162 half. So in an effort to lower my cost and to actually generate a credit on this particular strategy, I break a wing. So, don't let this sound like too much. It's, a one strike modification to create the broken wing unbalanced fly that is right at your expected range and goes for a good credit. Okay, now that would be fine if Apple traded flat to down a little bit, but I'm kind of leaving some credit out there if the market does open perfectly neutral. So we flip over to the other side and begin executing the exact same trade on the call side. This is also why this is so flexible. If you're bullish or bearish, it doesn't matter. You just apply the strategy on whichever side that you feel. So if you looked at this idea and said, well, I'm actually a little bit more just bearish on Apple, well, then you would construct the exact same strategy on this side. Notice how I've done the same thing by centering around the 175, which is where we expect our range to stay inside. Had I purchased the 170 call, that one was kind of prohibitively expensive. So you do the exact same thing by breaking that wing, paying a little bit less for the long call, and that allows the entire trade to generate a better net credit. Okay, so we've done the put side and the call side at expected ranges and taken in a good credit on both. Just like I showed you in Caterpillar, I don't try to take these all at once because in multi-leg spreads, trying to kind of coax yourself into them and working around these prices will give you a lot of advantage because, before earnings, you're going to have price moving kind of volatile anyway. And this allows you to try to work those prices. So as we work into the afternoon, I make a point to make sure that this is evenly balanced. So you can see call, 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 and then 3 on the put side as well. So this creates a strategy, and there's a lot of different ways to get to this type of a risk profile graph, but this now creates something that if Apple opens up and we trade inside that, 1.2% range. And let's see, and let me, and then Don, to your point, because you're asking, would putting this trade on be a better play than an iron condor? We'll see how it has a lot of similarities. And like I was saying, when you trade the iron condor and you see something come right into that, the place where you need to see it pause, you know how it feels to be sweating bullets in those spots and thinking, gosh, I really need to see this thing pause here. The biggest difference in that and this strategy is because if this moves to right there at the expected point of your range, you're going to have an in the money option to help protect against that. And you'll see that as this trade unfolds. Apple ended up being such a perfect example for several reasons. So, let me continue to elaborate on this, and I think it will help answer your question. And you purchase the fly one day before expiration and before the announcement and sell one day later, 1 day holding time. That is exactly right. Now, that's how these that I've shared with you this afternoon have laid out. You can do them in a huge variety of structures, and we'll be elaborating on that more, as we actually get into the course. But this will give you a good foundation on what you're trying to look for. The point that I was making on this just a moment ago was to say that if Apple did open up and we had that little, 1% move and it basically didn't do anything, well, then we would land ourselves right in the middle of this and still take in a nice credit on both of those trades, basically no sweat. As it ends up working out, Apple actually misses and guided lower. So this was, gosh, hindsight being 2020. But Apple was really kind of the first thing that had triggered this bigger decline in the market. So you think, okay, am I going to be taking any type of heat on this? Because if they've missed and guided lower, what is that going to do to the share price? And the immediate action, right after you got through the numbers it hit, Apple was doing a decent job of holding up. However, you get into the next day's action and it's a completely different story. So the markets open up and you can see where we have that break, and Apple just basically sells directly off from that point and continues to get hammered. Now you come back down into the snow line at 163.02, spend a little time of consolidating, and this is where things really become to get interesting because you think, okay, as this starts to sell off, remember, if you're sitting here with your iron condor and you've got the short 160 put, you know how it feels as price begins to approach those lows. However, if you have a strategy like this on, right out of the gates, you know that the calls are no problem whatsoever. So we initiated 3 of these call spreads for about 60 cents a piece. So that ends up yielding us $180 profit right out of the gates. All of these will expire worthless and there's nothing that you have to manage inside of them. However, as price begins to move lower, and you can see it here, this first shot was showing you where it tried to consolidate against 163 and then began to break down. Notice how in the next screenshot, price has progressed even further. And what you're trying to do is look at these situations and say, as price moves lower, this is beneficial for me and I don't have to sit here and panic about it because as we approach that short 160 put, the intrinsic value of the 162 half is going to increase. Notice how we took in a 68-cent credit and at the moment it was trading for a 73-cent credit. So I could have exited the trade at that moment and made about 140 bucks on each. But I'm sitting here thinking, okay, I know 160 is kind of like, you've got that big psychological value to it for one. Not to mention the work that we had done on it previously tells us that this is kind of the lower end of the range and where you should be able to start finding some synthetic support. So, how do I manage this trade? As we get down into the end of the day, this is the cleanest execution that I could ever ask for in an unbalanced fly type situation. You can see the 6 entries, all of the green ones down here. These are all of our opening positions where I've initiated a credit on all of them. And this is the way you love to exit this position because all your calls expire worthless. So you pocket the credit received and you also save commissions on the way out. The only thing that I end up paying commissions here, and look at the timestamp on each of these, because if you come back and you're referencing, the way price is falling right here, you're saying, okay, I'm trading 161.82. As we trade lower, the only thing that I need to do is sell my 162 half puts for as good of a credit as possible, and then provided Apple can continue to hold 160 at the cash close, well, then everything else down there just expires worthless. That offers the benefit of not having to close out those put options, saving you commissions, and then at the same time is going to get you a better exit on the 162 halves. Because if you're trying to exit this as a vertical, selling the 162 half and buying back one of the 160s just to exit as a vertical, it'll be a little bit trickier to get filled. Not to mention, a little bit more on the transaction cost side of things. So knowing that and thinking that way as I was heading into the close, then I can sit here and say, okay, 16 minutes until the cash close. I sold one of them for $1.70. 15 minutes towards the cash close. I sell it for another dime. Then, and if this is all, you got to finesse it and you've got to be kind of quick with this stuff. You get kind of where you're a little bit playing with fire to some degree, but, then 2 minutes or 8 minutes, 52 past the hour, 8 minutes before the cash markets close, you close out that remaining put option for $2. And then Apple ends up closing the session at about 160.70. So this was just a situation where even though coming back and looking at this and thinking, okay, Apple should have a pretty small move around this quarter, do you see how I was basically dead wrong on what I thought was going to happen in the underlying, but still had a very good trade result from it? To me, that is a night and day difference from just stepping in and selling the put credit spread. Also, think if you had looked at this and said, okay, I know my ranges, I just want to sell the put credit spread. Well, then as price comes down here and starts approaching those short strikes, it's more of a panic situation as opposed to looking at this and acknowledging, hey, I'm heading right into the peak profitability area of this, and I can have a certain degree of confidence in continuing to hold it because I know about that range. I know about, all of these various things that should act as support. And those concepts do tend to work a little bit better in your high liquidity, big names like Apple. So that was about as perfect of an example of those as I could look at. This is 3 examples of, taking the trade from all different perspectives. Caterpillar, we kind of scaled out of some of them as the full flies. The Amazon example was allowed to expire worthless by having risk in only one direction. And then on Apple, you scale out of the directional puts towards the end of the day, leaving everything else to expire worthless. And then the problem is if it drops substantially after hours and the short puts are in the money, you are at risk for assignment. And that is absolutely true, Joe. And this is why I like showing this example because, I'm trading my own personal cash with a real acknowledgement of those risks. And I'm willing to step in and take those risks because of the work that I've done on it previously. And then, do you ever sell at market of the end of the day? Well, I try not to do it at market, but that is something where if you're getting, really down to the wire and you just have a couple of seconds left, I always feel like if you have a good understanding of the bid ask, you never have to do a market order. You want to sell it, just go in and hit the bid. So you could do it as a market order, or you could just come in and sell at the bid, both effective ways of getting out. And then do you always look at 6 days to determine the range? Well, that depends entirely upon the earnings play. So if an earnings play is set to result or set to give the results on Monday afternoon, well, then I have to consider the move into Tuesday. And I also have to consider the move into Friday. If you're doing it from Thursday into Friday, they tend to be about the same value. And then was there high open interest at the 160 strike? You'd be surprised, Joyce. There was not as much as I thought there would be. And if you are a Simpler Options member and you'd like to have a live review of these trades, go back to that Friday's video. I typically will be doing Friday or videos on Monday and Friday. And of course, with this being a Friday day trade, the very first part of that video goes through all those details. It's basically to say there was higher open interest at the 165 strike. So I used that information a little bit towards the end of the day, but it wasn't quite as helpful as you may have thought. And then on the Amazon unbalanced butterfly with no risk to the upside, how do you manage risk to the downside if Amazon starts dropping? Well, there's a couple ways of looking at that. And to be completely upfront and honest with you, if Amazon explodes to the downside, and this is also why And I think each person will come to grips with, do I enjoy doing earnings trades? I think they can be great because there's so much you can learn so quickly. At the same time, if Amazon was to open up down at 1300, that trade is toast. But how many times have you had like a put credit spread at the money, you don't get the direction right and it gets hammered? That kind of stuff happens if you're going to play earnings. So there is risk involved to the downside. It just depends on how far down I gap. So in this Amazon example, you're looking at it saying you traded 1526. Well, if I gap down and I'm trading something like 1370, I'm still in good shape and I actually still have a decent chance of making some good money. If it's trading down towards 1350, 1340, I'm usually going to try and cut it and salvage that as quickly as I can. But it also depends, just like Apple. Are you trading inside the expected range to a point where you might be able to start working some support back to the upside, or has this thing just been completely hammered? Now, also, mind you, these are very sharp examples that have very quick, I'm in and out, and that's how the whole thing worked. If you're doing this from a more conservative standpoint and saying, I would like to initiate the trade 14 days out and maybe do it with a Delta 20 option, a little ways out of the money. Well, then you can typically work around them. You can modify, move your strikes down a little bit lower. You can always do, like in this case, say maybe you're not as bullish as I was in Amazon, do the call side to complement it. So that credit will help you if it is all the way down against you against these strikes. So it's situational dependent, and there's a couple of ways to do it. And then this is all detailed. And if it's a little bit new to you, I would encourage you to, try to be open to new things because when you look at things like this, it's very easy to come in and say, okay, if I buy a call and it goes up, I make money. If it goes down, I lose money. I know that's very basic and straightforward, but the whole purpose in my mind of becoming an options trader was to learn more strategies like this where I don't have to pick direction. I can work off of some volatility, I can work off of these given ranges. That's the way I think, it's a great way to learn how to do it. And then when selling those long 162 half puts, you are now short 3 160 puts. Does the broker allow that, or do you have to have money in your account to cover it, even though they'll go out worthless? That's an excellent question, AJ, and both comments are true. So in this case, I had the cash to allow, because you've got to think once you sell that in the money put option, you're basically sitting out there with a ratio spread where you're short 3 of the 160s and then long 2 of the 165s below it. So if you could hold that ratio spread, meaning if if you've got the cash and the buying power requirements to hold that ratio spread, like I showed you in this case, all I'm having to do is just exit the directional put options. If you look at this and say, well, I've got a smaller account and I can't really do that, it's still very simple to just sell the vertical. See how here I did just the exit of the put options? If you needed to do the vertical, you would be selling that put option while simultaneously buying one of the 175s. And then at that point, you would have two short puts, two long puts, and your risk is very cleanly managed, and your broker is going to have no problems with that. And then I will always try to close the shorts for a penny, and there's not a thing in the world wrong with that. Like trading, there's so many ways of going about this, and there are so many ways of making money. And I've got to admit that doing this trade like I did in Apple is a little bit cute. You know why I do that? Because that's how I grew up. And I feel like learning from some of the best, and as I was going through the images to put all this together through my Dropbox, I found that image of John pinning Apple at exactly 500. And, stuff like that, like we talked about at the beginning of this, there's certain things that inspire you and how you go about trading them. If you look at this and say, that's ludicrous, I'm going to buy back my short puts, don't let me stop you. I'm just kind of showing you, different ways of thinking about going about this. And then, is this strategy for earnings only? Absolutely not. You can apply this in absolutely any market environment. And a couple others that we can look at because I've got a couple that I'm working right now, and we're pulling back on me a little bit. I still think that these are going to be in places that are very easy to manage. So while a lot of these I've discussed with you were earnings based, because I wanted you to see how they come from one day in, the next day you're out, and you can see how you can make cash with them just that quickly. If you come in and look at what I'm trying to do with the spiders and some of these others, you can look at the idea of saying, even after these declines, we're sitting here trading 259 on the spiders. And for the position I have on now, I have no risk to the upside should the market start to find its footing. By initiating my short body at 250, that means that over the course of the next, week and one day, the spiders could come all the way down to 250, and that is actually where I maximize my profit. Now it's, are you playing with fire here? Maybe a little bit. I think I'm doing this far enough out of the money that it won't be a concern. And if we did fall all the way down there, that's actually where it ends up becoming, a more advantageous strategy. That's where you pin, right? And that's where you actually receive the maximum profit of this strategy. I like showing it in this way because if I'm wrong and the underlying does end up just getting completely hammered, I still have defined risk. So, there's a couple of these that I'm still working in. You do not have to do them just for earnings. They work great in the indexes. They work great on anything that has good implied volatility. You want to see another spot where I was so thankful to have the unbalanced fly on as opposed to a standard fly? To try to win. Because win, and anytime you have something that is in the headlines and has whatever negative connotation to it that it happens to find itself in at the time, I look at this and say, this sharp drop lower, I think gives me an opportunity to come in and try and sell premium. I didn't necessarily want to sell those puts naked, but by coming in and doing a trade that involves the short 160 put, how do you think I felt that morning when his resignation came through and the stock was up 12 bucks? Obviously, you're sitting here thinking this is no sweat whatsoever because by initiating it for the credit, anything to the upside I have no problem with. Also, notice how the pullback today didn't bother me whatsoever because now all I'm thinking is can I fall down to 160? Because at that point, my 165 put is going to be worth $5. If I can stop at 160, those will all expire worthless. And that's just one more spot where you can put these on in equity positions. You just need to see that good implied volatility. And then if you sell a vertical credit spread, you only have risk in one direction and less commissions. And that is absolutely true. But think about the difference in having a put credit spread that is sitting right there testing your short strike. And, as I convey some of these things that, why do I do this? Because, believe it or not, I have sold a put credit spread in my life. So why do I opt to do something like this instead of that? Because think about if Win hadn't just rebounded in a big way, and think about if it sits there and keeps sitting at 160. Well, you're going to be sitting there kind of biting your nails around expiration, thinking, oh, I sure hope these 160 puts stay out of the money, instead of having the unbalanced fly while you're sitting there with that in the money option. See how the in the money option and how it maintains its intrinsic value will help you in those situations? So, yeah, you can, there's 1,000 different ways to do it. I like being able to sit right there at those short strikes, and not having to be panicked or sweating it, knowing that that is what I wanted to happen. Take the Apple trade for an example, just to come back on this and show it one more time. Think about how I would have been feeling at this spot right here as Apple's approaching, and if I'm just sitting there with my put credit spread. That's not a favorable spot to be, but by having the other side of the trade on, it just gives you a lot of different ways to look at it, a lot of different ways to make money. And then I'll look at a couple more questions here. And then they can be used for longer term directional setups with a high IV rank. That is exactly right. The only thing you need is implied volatility. And that's why, these have, I've loved doing them around earnings, but of course, as the market went straight up through January, I didn't do a whole lot of these. Now that volatility is coming back to us, it's a wonderful opportunity to do them. And then how do you know how much credit is a good credit? That is a question that I'm going to get more into when we actually do the course because there are so many different ways of doing this. I will initiate these trades all the way from, risking 1 to make 3, and then I will also do them as far as taking in as small as a nickel credit. So if you're taking in the nickel credit, that's going to be a very different management than if you're taking $2 or $3 in on the credit. And that will determine how you decide to manage it. And then if the Amazon Feb 16, I could do the vertical for 60 cents and let's see, let me read this back. And then if I did the same, so you're discussing doing, and also Zach, when you're pricing those spreads out, and of course I'd have to dive into it to look at the spread price with you, but remember that trying to discuss a spread price while the market is closed can be kind of difficult. You're looking at something like Amazon that's going to have kind of wide spreads anyway. So if you're looking at that thinking they're the same price, remember you kind of need to see the market open and see where they are truly trading. And then past that, I feel like if you're going to look at those and say they do trade for a very similar credit, I still think the unbalance is going to be more favorable because if you pull back, the same discussion we've been having, think about the put spread and you're right there at your short strike and think about how you feel. Then think about how you feel if you're at that strike, but then you've got a nice in the money option that is cushioning that move. So if they truly were going for the same credit, I think the unbalance is an easy decision. And then I thought about doing the spider unbalance the other way, putting the body around the 8 or the 21 with no downside worries. Could that work as well? Well, in this case, of course, the market is sold off pretty sharply. So I may not understand that question exactly correctly, Sung. It depends on which direction you're placing it. But I do like using the moving averages for general areas of support and resistance. And then are you always trying to pin it for a max profit? Well, it depends on how it trades, right? Because if Apple would have opened up neutral, of course I'm not going to work for the pin. I'm just going to let both sides expire worthless. When I see price action like what I saw in Apple, like what I saw in Caterpillar, then yeah, I'm going to try to work it for as close of a pin as I can get. And then what do you consider good implied volatility? A lot of times when that comes up, I will default back to the IV rank, which is just taking the current implied volatility and comparing that to a 52-week number of that. You can take that and say, because you're looking for implied volatility in relation to itself. So you would take your current IV ranking, and I think I even have it on my primary swing charts if we flip over to those real quick. So, at the beginning of the discussion, I had shared with you that I think there's, kind of two ways that traders tend to look at things. You'll either have the math based folks that like looking at things saying, like, and it's kind of a little tricky to see based off your colors, but see in the top left hand corner where I've got an IV percentile of 77.3, that lets me know that we're in an upper third percentile. I try to think in rules of thirds for a lot of things in life, but implied volatility is no different. So if I'm in the upper third on this point, then I know that I've got pretty good implied volatility and an opportunity to sell that. So these are, and hopefully the review of some of these questions has been helpful. I feel like my whole purpose in life has been to take these, the things that I have learned from John and distill it in a slightly different way, hopefully making it more understandable for people that are just trying to dip their toes into it, and for people that, don't necessarily want to come out and just play directional options up or down. If you want to try to think a little bit more, how can I put these probabilities in my favor? How can I try to work ranges? Then I think that these will be extremely helpful. So if it's something that you have some interest in and you think you'd like to join us for the next round of this stuff, I'm going to be doing the actual full course of this, which is going to be 3 hours on Thursday. Today I wanted to show you this is what I do in these situations, and this is how I think. This is how I structure these trades. If you want to break it down and go step by step by step and say, okay, I've never done one before. How do I get in? What credit should I take in? Do I have good enough implied volatility? How do I manage it? The endless list of questions that come up anytime you're thinking about taking and managing a trade. If you'd like to spend more time doing that, I'm going to be doing that on Thursday. And if it's something you're interested in, like I said, I think I'm looking forward to it. I think that this is a great way to trade. Um, And then also on that, we're going to do the full course on Thursday. If you'd like to have an hour of live trading the day after, we're going to do that too. And then the elite package, which is kind of, kind of a jump, but this includes the live mentorship that John, myself, pretty much the whole Simpler Trading crew is going to be a part of, and that's going to be March 25th through 27th. I always love doing those because it helps me, get to know the people that you've got on the other side of the screen that we're all just traders trying to do the same thing and working these in a live environment. I like them because they're intensive. So for myself, for those 3 days, I can just sit there and all I have to focus on is options trading. I don't know. I really enjoy doing them. I may be a little bit biased, but that's what I'm going to be doing for a week from now. And then also as we get into the mentorship, and if you want to dive into it a little bit deeper, I look forward to spending some time with you, through one of those various options. And then what's the name of the indicator that provides the IV ranking, the ATR, etc.? So any of those scripts that are free and publicly available, I'm happy to include with you as I create the workspaces for this course. That earnings indicator is a whole different thing. And, Eric coded that up and it's a separate indicator. So anything that's free and publicly available, I'll be happy to get those scripts to you and you can have the exact workspace. Anything else that is a proprietary kind of add-on, I'll do anything I can to help you out on it. But there are some add-ons on that type of stuff. And then is there a Trading Stocks 101 class? Well, if you log into the site, Travis, and I'm not sure if you're a member or not, but you can take a trial on the site. And if you log in for that 30-day period, we've got a whole section devoted to, beginner, like this is a call, this is a put. And if you feel more comfortable with that, there's lots of good resources for that as well. No problem, Travis. I appreciate you being here and I appreciate the questions too. Don't ever be afraid to ask stuff like that. But at the same time, don't be afraid to embrace a new way of thinking. And then it sounds like this type of trade requires more constant monitoring. Is it a viable option for someone who can't watch the market constantly? Absolutely, Chip. And it really just comes back down to, remember, these earnings examples are shown in a way that are very quick in an effort to show you start to finish all in one very quick movement. You can also take, and the example that I was showing you was like that win trade or, any of the other equity positions that we've been putting on. You can absolutely, and sometimes I always joke about people in the chat room about this, where it's like a blessing and a curse to sit there and watch your charts on 5-minute basis. If you set these as limit orders and manage them in that way, this is still a perfectly appropriate trade for this. It's like the opposite of day trading. So yes, I do think you would find it helpful. Thanks, Drummer John and Stevie, Samantu. I really appreciate you guys. I know I'm very fortunate to get to spend a lot of my time with you, and hopefully in the return of that, you have found something helpful. And then so the live trading is going to be on the 15th, and the screen that you have up right here should show you the packages for each of these. So like I said, the basic course will be on Thursday. The add-on includes an hour of live trading on Friday. And of course, I'll take as much time as needed to make sure everyone gets everything answered and that they're good with the way things have played out. Not to say that every trade's going to be perfect, but that your understanding of it will be perfect. So thank you, Bill and Jeannie. G, it's great to see you guys. Thanks for stopping by for a little bit. I hope you found it useful, and I hope that, I hope to see you next Thursday. Excellent. Thank you, Salah. Good to hear from you, my friend. At this point, I look back at this and think, I've been doing this for 7, 8 years now with John. So you always appreciate the people that you do get to know kind of on a personal basis, and I'm lucky to get to trade with you guys. Thank you, Bob and Captain Kirk. Sonny, I appreciate you taking some time out of your afternoon to join us. Like I said, I hope you have found these examples helpful. There will be a recording of it if you'd like to go through it and review it again. And then, of course, on next Thursday, pretty much same time, same channel, and I'll be here going through these all in a lot more detail with you. And then, Rose, I try to see every question I can. I try to answer every question I can, but sometimes they scroll past kind of quickly. And then, do you need to have a large account to be able to carry the credit you get? Absolutely not. Now, I will tell you that I don't do these super narrow. I'm going to do them at least $2 or $3 wide. So, say that you did one, like we've got one on right now in the diamonds, that's $3 wide. We took in like a 5-10 cent credit on it. So in that case, if it's $3 wide and you're taking in about a 10-cent credit, you only need $300 to carry the position. And that's the big difference in not doing it naked. Because if you're doing it naked, it would require a lot more buying power. But by structuring the ratio correctly, you get a lot of benefit of selling that out of a chunk of those out of the money options. But at the same time, the risk is still clearly defined. You're very welcome. Thanks for joining us this afternoon. And then the recording of the webinars, we usually quote about 24 hours, but they tend to be faster than that, W. I would be surprised if you didn't have it in your inbox by the end of the evening. And then could you do several butterflies at points apart, like one centered on 160, a third around 170? You absolutely can. And I think that's a great way to do it. The only catch to that, Tom, is you've got to do them to a width or like kind of with a little bit of foresight because you don't want to cancel out other strikes. So I do like kind of legging into them as something moves lower, but you just got to make sure that you don't cancel any of the other legs with the execution of your fresh ones. And then generally, how much time do you give yourself for these trades? 1 week, weeks? Generally speaking, for my favorite equity positions, when those work out well, it's about a 2-week trade. If you're going longer than that, you're probably having to work through a modify a touch. Remember, you can do these as far out as you want to, but just like typical, we talk about this all the time with theta decay. As you get closer to expiration, it ramps up. It moves exponentially, not linearly. So, you can do them 30, 60 days out. They're just going to move so slow. You do them 14, 7 days out, 1 day for these earnings examples, well, then you're going to get your results a lot quicker. And then do you ever use the unbalanced fly as an adjustment for long calls that you bought? I think that using the unbalanced fly as an adjustment strategy is a great way to do it. You'll see, and if you go back through these, you can see on Amazon where I did the unbalanced fly to complement the iron fly. You could use it to complement a long call. You could, it's once you start getting a good foundation with option spreads, there's an infinite number of way of customizing them. And we'll talk about that when we go through the course. And thank you, Sean. I really appreciate it. I'm so fortunate to have, fallen into this vocation and then to be able to share it with you guys. I hope it comes through in the right way, and I hope you have found it helpful. So I'll hang out for a little bit and answer any other questions that you guys may have. I think we are pretty much getting down to the end of it. So thank you, Sam. I appreciate you being here, and I'm glad you found it helpful. John, I don't know if you had anything else that you wanted to add to this. I feel like that's pretty much a solid summary of everything that I wanted to present with you guys this evening. And then I've learned so much on SO about the butterflies, and you have changed my trading so much. Well, thank you, SJ. I've really enjoyed the conversations that you and I have shared in the chat. It means a lot to me to have other people on the side that you can, converse with and share these ideas, and, to know that it's been helpful to you makes it all worthwhile. So thank you, Sharon and Richard, Alex. I appreciate you guys being here. All right, JC, if you had a few other comments you'd like to add, I'll be more than happy to turn things over to you. But in conclusion, thanks again for joining me this evening. I hope you found the information helpful and kind of the path that I have taken to get here. You guys have a great rest of your evening. I'll turn things over to John now, and I hope to see you guys next Thursday. Okay, well, it looks like John was having a little bit of issues with his mic, but it's no big deal. Like I said, I think at this point you guys know where I'm coming from, know a couple of ways of looking at this stuff, and if you find it helpful, I look forward to seeing you next Thursday. If there's anything else I can do to help, you can always find me in the chat room first thing in the morning. And other than that, just wanted to thank you guys once more for joining us and give a formal end to tonight's webinar. So, thanks again. Everything was recorded, so if you missed any piece of it, you could expect to see that in your inbox here in the next couple of hours. And if you have any other questions or anything else that you'd like to decide before getting involved with it, just give us a call here at the office and we'll be happy to help. You guys have a great rest of your evening, and I hope to see you again soon.